We actually were very fortunate through the crisis, and that starts with our AA credit rating. And so it was a bit of a reaffirmation of a number of things that we had put in place, even leading up to the crisis, not that we knew that was coming. We were able to fund commercial paper, $10 billion commercial paper at LIBOR minus 200. And even through the balance of 2009, LIBOR minus 80 range. And so I can tell from some of the looks out there that maybe that wasn't everybody's experience, but we were fortunate in that. So that really reaffirmed, again, what we were criticized for of being overly conservative and then able to leverage that.
Well, that certainly wasn't my experience, I can tell you that. We coincidentally were faced with a refinancing need of 60% of our debt book. And being an A- corporate, just having had a large acquisition that we were still digesting, it left us in very vulnerable spot with the rating agencies. That reinforced for us the importance of conservative financial policies. We tend to think about our environment from a static perspective. And of course, what has happened in this particular period is that was challenged to the maximum degree. So point-in-time risk of your debt book is an important takeaway for me. You have to spread it out. Secondly, of course, cash was laying around the group pretty idly, and that changed rapidly after it became apparent to us what our position was.
From a bank standpoint, it's very much how do we assist corporate clients in utilizing some of that idle cash that probably historically was based in local banks, maybe in currencies that historically looked attractive from an interest rate standpoint, but looking at the risk policies, looking at the drying up of the credit market, is how do we work with clients to bring that cash back into central positions? How do we fund those positions for our corporate clients? And how do we then utilize those credit lines for those emergencies are actually needed? I mean, I think we've seen in 2008 that liquidity very much is the lifeblood of the organization, and what was key is to ensure that you had the correct amount of liquidity in the correct location.
The key impact of recent financial crisis was on the perception of the crisis. Due to the very integrated market, now things which could not be a crisis before now can be a crisis. And so correlation is a very buzzword at the moment. And also because of the crisis is now very kind of a fractal basis. So the roughness or irregularity is a common character of the crisis at the moment.
The concern about potential constraints on credit, it's a big part of our strategy is with a significant commercial paper program to have backup lines of credit. While they're unfunded, they could potentially have a significant capital charge, and understand that across our banks. And so, we're hopeful that we can have a joint voice with some of the regulators on what the true commercial impact of that might be.
More collaboration. Matt mentions the $1.5 billion of LCs that he apparently didn't need and gave back. That is a very good example as to how we jointly should work on the efficiency of our overall, let's say, service that is exchanged between a financial institution and a corporate. I do look at that as a collaborative action. It is not a one party that has to do all of the work. If you have more expensive assets in the context of the equity that you need to hold, and that pushes out assets on one side and it pushes up your equity on the other side, it is going to reduce your return on equity. Shareholders need to get used to that. Until that has taken place, you will see pressures from banks to increase fees or keep fees at levels that perhaps don't reflect the efficiency possibilities that are currently around, and of which Switch is a great supplier and so forth. That will create tensions between corporates and banks.
We have to leverage technology, changes in payment innovation. I think it's very much for the banks to ensure that we can provide best practice back to the corporates, and that's really our challenge and something that we look forward to in passing back to our clients.
Crises don't repeat themselves exactly over. I don't think, even though liquidity should be on our radar screen and credit should be on our radar screen very firmly, and will be so as a result of more conservative policies that are triggered by our changed risk perception, it's not the next thing out there. And if I would have to make a guesstimate as to where the next thing out there is going to come from, I think it's from the corner of FX, the tensions around monetary policies and how different countries are actually positioning themselves in the international arena is creating the potential for significant upset in that perspective with all sorts of fallout in terms of international trade. So refinancing risk has to remain on the radar screen with a changed landscape in which that is going to take place.